Financing for Development, Unlocking Investment Opportunities. What is financing for development? With Susan McAdams.
What is financing for development? This story begins 15 years ago, in 2000, when the 8 Millennium Development Goals, or MDGs, were adopted. Countries and development institutions and NGOs increased the focus of their efforts on reaching the MDGs, and part of the financing for development response was then that the world created a number of MDG-specific funds for education, for the environment, especially for health. 3 of the MDGs relate to health. Well, the 17 Sustainable Development Goals, or the SDGs, are different. It's a comprehensive group of goals for the entire world to achieve. So how will we finance their achievement? The answer will also take the entire globe. Financing for development is needed in each country. It's needed globally. It's needed for the public sector. It's needed for private investment. So what does financing for development actually mean? To begin with, we aren't saying money for development. We're saying financing for development. What's the difference? Money is just a good, it's a thing that acts as a medium of exchange. It can be cash, it can be intangible, like the amount in your bank account. Money is a very useful thing, but money by itself doesn't do the trick. What matters really is how you manage it, and that's where finance and for development come in. Finance is actually both a noun and a verb with 2 related but distinct meanings. Finance as a noun is the whole discipline, art and science, of managing money. So my career, for example, is in finance. I've been fortunate to lead the teams here at the World Bank that negotiate development contributions from governments and foundations and others. And then we collect those funds, we hold them, we invest them, we disperse those funds for development purposes. That's the noun. Finance in this case, it means the whole of financial management. Well, what about the verb? Finance also means providing money. If you make a contribution to educate girls in a developing country, for example, you are financing that effort. When we talk about financing for development, it's good to keep both the noun, the financial management piece, and the verb, money flowing, financing, in mind. So in terms of financial management, we want to use every last dollar, yen, euro, renminbi, rand available as effectively as we possibly can. So the financing that we use, it goes out in the form of some basic instruments. Often we think of these in terms of the cost to the recipient of those funds, beginning, for example, with grants, moving to loans, which require interest payments, and then other forms of more expensive finance and direct investment, like equity investment, buying a stock. Specifically, the main categories include grants, concessional loans, very important to development finance. These are loans so the borrower pays them back, but usually with a very low or no interest. Then there are regular loans. These have interest rates based on market rates and on the borrower's credit rating. So this can be very important in the development context where different countries have very different credit and capacity. Then there are guarantees, where one party agrees to pay a lender back if the borrower doesn't. Again, this can be very important when a borrower has limited capacity but very important needs. Straight into the private sector side, there is equity investment. This is where money is provided to start a new company. The investor, anybody providing that money, owns a share of the new company itself. If the company does well, it'll make money, it'll make profits. If it doesn't do well, you'll lose your investment funds. In addition to this spectrum from grants to equity and guarantees, there are a number of creative ways to combine them, to use them, to structure finance, to increase the impact. So development institutions that borrow money from the capital markets, it's what we do and we'll explore in more depth in Module 4, use bonds. These are loans from investors through the capital markets. The development institutions have created instruments like vaccine bonds or green bonds, or using bonds as a way to insure against catastrophes. These are ways that you can structure finance to come up with a new instrument that's tailored to what you really need. One way we can use the money we have as effectively as possible then is to tailor the finance itself specifically to the need using all those instruments. We want to match the financial instrument to its specific use. For example, one would prefer to use grants or concessional loans in the poorest countries or in situations of fragility or where there's conflict, because those are situations where it's going to be much harder to ask, and not very sensible, to ask governments or people to pay the loans back. In middle-income countries, they can afford to pay back loans, and regular loans can make a lot of sense to help them make the investments that they need to make in their own development. This is where we get smart money, using the finance itself to make its impact more important and more successful. So where's the money? Well, we're going to need more money to achieve this 2030 agenda. There are a lot of estimates about what it will cost to achieve the Sustainable Development Goals. We are a bit leery of these estimates, and let me say that the point of estimating the cost at all is really to make people sit up and think about it. In any case, we are talking trillions of dollars that are needed every year across the world, and that's a lot of money. We have included in the materials a quick exercise to help you get a bit more concrete yourself about what a trillion means. But the main message here is not that we know how much the SDGs will cost to achieve. We absolutely don't. The challenges, the priorities, the needs will vary country to country and issue to issue, and they are interrelated. You can't estimate, for example, what the cost would be for each goal because the goals interact with each other and they affect each other. For example, smart spending on education, especially girls' education, will also help the health goals because educated girls will find ways to have their own kids and each other be more healthy as they grow up. So the financing for development approach that we want to take is that we need to focus both on more financing and on effective financing. So it's more money and smarter money to reach the SDGs. One last note, where will this money come from? Well, ultimately, this is all money that individual people pay in one form or another. The biggest form is paying taxes. This is where governments get their money, governments all over the world. Or where people save, or give, or put into banks, or invest themselves in companies, or bonds, or equities, or pension funds, or mutual funds. And where they put that money will end up in companies, in development institutions, in governments, in NGOs, lots of places where they will go ahead and spend specifically on development. So financing for development ultimately is money that comes from you and me and millions, well, billions of others who in turn entrust it to others who invest it and deploy it. In the end, we are all stakeholders in the finance for development agenda.